what is the best US ETF to buy if you're a passive investor? Let's dive straight into it. Hi guys, this is Pete here. Welcome back. So today I'm going to talk about what is the best US ETF to buy if you are an investor that is not in the US, okay? So the most common ETF that people would talk about is actually this one, right? It's actually the S&P 500 ETF done by SPY, which is SPY, okay? This is a really good ETF. It's highly liquid, right? And it has a relatively low gross expense ratio. So today, I'm going to talk about ETF that can give me even better returns, but also to tackle one problem that exists for non-US investors that are investing in the US stock market. And that is this thing called the estate tax. Okay, so for those of you who have been following me a while, in the last couple of months, I've been very focused on how do I optimize my estate planning, my legacy. Okay, so for those of you who want to find out more, right, I did a live session with my good friend Cheng Kok on estate planning earlier on. I'll just put the link in the description. But let's come back here, right, is that while we can do estate planning for our real estate, for our other properties and stuff, but in terms of stocks, okay, you might be subjected to a very hefty penalty called the estate tax when you pass away and your children have to take over the asset, okay? Now, for those of us who are investing in the US, right, this estate tax can go up to as high as, look over here, 40%, okay? Now, there is an exemption. That is if your investment amount at the transfer period, right, is less than $60,000. So if you have less than $60,000, I would say then you don't have to watch any further already, okay? Right? This will not apply to you. But for those of us who are investing way more than that in the US stock market, you need to pay attention because, for example, if you are transferring about $1 million, your tax that you're paying can be $345,000. So that is over 34.5% of tax they're going to pay for estate tax when you pass on to your next generation. But why do we have to pay estate tax? And that is because the ETF SPY is domiciled in this place called the United States, okay? So for anything that's domiciled in the USA, you will have to pay this estate tax. And the question is there anything we can do to not pay this estate tax? A lot of times people come to me and say, there's not much we can do, but I want to show you that we can, okay? But before that, let me just touch on another tax that you have to pay. It's not just estate tax. This is also something that I think many of you will be aware of, which is called the withholding tax. Now, this applies to the dividend that you collect, okay? So when you collect a dividend, in the US, they treat it as though it is a salary, okay? And for non-US citizen, you have a withholding tax of 30%, right? So if you're getting dividend of, let's say, 6%, right? After they have deducted the 30%, you are only going to get around 4% instead of 6%. Okay? So I think Sidley summarized this very well for everybody that the withholding tax for dividend is actually about 30%. Okay? For US estate tax is about 18 to 40% depending on the amount you hand over. So is there anything we can do about it or there is nothing we can do? So welcome to the land of this place. Okay, where is this place? This is actually a very nice place in the UK. Right? And that is Ireland. Okay? So there are actually ETF that are domiciled in the Ireland. Okay? So if you're buying this ETF, then you will be able to not pay the estate tax because for non-Irish citizens and non-US citizens in Ireland, if you're buying Ireland domiciled ETF, you don't have to pay estate tax. And on top of that, you also pay a reduced withholding tax because of the treaty between US and Ireland, okay? So I'll give you an example over here. This is a ETF that tracks the S&P 500. This is the iShare Core S&P 500 ETF, okay? The ticker symbol is CSPX. With this ETF, you will be able to track exactly the S&P 500. You don't have to pay estate tax. And on top of that, if you look over here, just now when we talk about S&P 500, your expense ratio is about 0.09%. Over here is even lower, is 0.07%. Okay? And what about, hey, if we need to pay withholding tax, right? There's still a 15% withholding tax that we have to pay over here. So can we not pay withholding tax? And the answer is actually yes. Okay? That is if you invested in another type. Okay, so there are a lot of types of S&P 500 ETF, right? So this is the iShare S&P 500 swap ETF. So what they do is that they don't fully replicate the S&P 500. That means they don't just buy the shares in S&P 500, but what they do is they use this thing called the futures. Okay, so use futures contract to replicate the S&P 500. Therefore, they do not need to collect that dividend. So you don't have to pay the dividend tax in this case, right? So these two are actually quite amazing. So when I pack them side by side, you can see over here, just by not paying the dividend tax, the withholding tax of 30%, you can see that the I500, which is the synthetic ETF, actually outperforms the fully replicated, the physical ETF of CSPX over here. And honestly, if I pack it to just SPY, you can see that among the three of them, actually SPY is the worst performing. So over here, you may ask, hey Pete, I understand why I500 can outperform the other two, right? Because of the dividend tax not being charged. But why is CSPX performing better than SPY? And that is because the difference between CSPX and SPY is not just where it's domiciled, but also the point about dividend. Okay, so you can see over here, the distribution policies for dividend for CSPX is actually accumulating. That means they do not give you the dividend, but what they do is that they take the dividend and reinvest into the ETF itself. So that actually saves you a lot of trouble if you're not investing in the S&P 500 just for the dividend, right? This actually helps in your longer term returns. You can see over here, just by looking at the last 5 years, the difference between CSPX and S&P 500 is close to 6% difference. So if you're investing like $1 million, this could be $60,000 difference already. So once again, let me just highlight the difference between CSPX, okay, which is almost a replica of S&P 500 versus the I500. Okay, they are both actually by iShare, so no main difference there. But the main difference is actually how they replicate the S&P 500 return. One is really by just buying the S&P 500 company shares, and the other one is they do buy the shares, but they use future contracts to actually synthetically replicate the return so that they do not have to pay that 30% withholding tax on dividend. For S&P 500, I've listed down here all the Ireland domiciled ETF that I think are suitable. Now, a few things that I'm personally looking out for when I'm considering which ETF to buy, right? Number one is actually, of course, the expense ratio. So over here, you can see that actually CSPX, although it's lesser than the S&P 500, the SPY, 0.09, right, at 0.07, but they're actually even lower one, as low as 0.03, okay, and that is SPYL. But the thing is this is a relatively new ETF, so therefore they don't even have past track record just yet, okay, that's not listed. And on top of that, another thing I look out for is actually the fund size, because I want to know that this is a liquid ETF, so that if I want to buy and sell, my bid and ask spread is not so big, you see, right? SPYL over here is actually not a very big fund, okay, whereas CSPX is by far the largest among the Irish ETF over here, okay? So you can see, once again, the difference between replication, between full replication and swap base, which is using the futures contract, right, is that generally, those that are using futures contract, which are synthetically replicating, okay, get better returns. So over here, you can see the I500 and the P500, right, perform at 43.88% versus the normal replication, which is only at 42.78, 42.77. Okay, so you get almost like a 1% improvement in just a 3-year return at no extra cost to you. Okay, so this is the S&P 500. Now, for those of you who are also investing not just in S&P 500 but in NASDAQ, okay, the good news is this: there are also Irish domiciled NASDAQ ETFs, so that you can avoid paying the estate tax and potentially even avoiding the dividend tax. Okay, so I've listed down over here. The biggest one is this one over here, CNDX. Now, do take note that such ETF may be listed in different brokerages using different ticker symbols. So for example, the number one that's by iShares again, okay, the CNDX is the common ticker, but if you are using other brokerages that may not have CNDX, you might need to search the other ticker, which is actually SXRV. Okay, so there are tickers differences over here, but this is by far the largest, a very, very liquid fund, you will notice that for NASDAQ, generally the expense ratio is higher. So you can buy ETF that are of lower expense ratio. So for example, there are these three, they are just 0.2. Okay. So personally, for me, what I want for NASDAQ is that I want something that has given me good track record, but at the same time, I don't want something that is very illiquid. So at this point in time, I would not consider the last four over here, but what I would consider is something maybe like EQQB and EQQQ, okay, where they are 0.3, so it's actually lesser than an iShare one, but they are relatively liquid. Okay, now the distribution difference between these two is that EQQB accumulates, whereas EQQQ distributes. So overall, I think over here, I will look at EQQB, okay, that can help you to accumulate. And let me just go back to S&P 500. Over here, when I look at everything all, considered, I think what I would prefer over here is either going to be P500 or I500 because they are both accumulating and they are both synthetic. Now, of course, there is risk about it being synthetically replicated. It's got to do with the maker, which is actually iShares or Investco in this case. But I think these two guys are very reputable. So I don't think there's any third-party risk over here. Okay, lastly, let me just talk about a few things that I would personally take note of when I invest in such ETF. Number one is that the volume really plays a part. Okay, if you buy something that's very illiquid, very few shares, even though they might promise you a very low expense ratio from the get-go, right? Your bid and ask spread can be so wide that actually it may not be as profitable. Okay. Number two is that most of these ETF, because they are overseas domiciled, they actually do not have US options available. So if you're like me, also using ETF options to trade and invest in your portfolio, then you want to take note that you will not be able to do options on this ETF. Okay. Number three is that sometimes because of their domicile, you might need to use euros as the currency to purchase this. Okay, so therefore, because it's not just in the US, it's also not available in most of the brokerages. Personally, I do find it in Interactive Brokers, and Interactive Brokers currently also allows you to exchange your euros into US quite easily on the platform itself. Okay, so these are the main things that I will take note of when I want to invest in this alternative ETF to the US domicile ETF. Alright, so lastly, is there anything we can do? Definitely. There are a lot of things that you can look out for. One thing I just want to highlight again is that there is no solution if you were to buy individual shares in the US stock market at this point in time. But I do believe as technology advances, as regulation change, there will be alternative methods that we can do this so that you can avoid estate tax. Personally, what I will potentially do is that those that I'm investing in individual shares, I'll keep it as it is. But when I'm a lot older, okay, let's say I'm at retirement age and I want to hand over to my children, then I might just convert everything over to this ETF to facilitate the handover. Alright guys, so I hope you guys learned a lot from this session. This was quite an interesting topic for me as well because it was actually a request from one of my investing clients to talk about estate planning. Okay, so once again guys, if you're looking at estate planning, I'll just put a link down below where I did a recording with ChainCorp about beyond the stock market. If you're looking at real estate or other asset in your portfolio, how can you plan it well such that it's not just about the taxes, but also to make sure that it is distributed according to your will properly. Okay, so that's all I have for this session. Let me know if you have any questions. And if you like the content over here, once again, do like and subscribe. And I'll see you guys next time. Bye.